Back in March, and not just on any old day in March, mind you, but on March 9th, the stock market low, Marc Faber predicted stocks would take off in a 6-month rally. He was so right. Now we're 6 months into this rally, so now what? Well, let's put that question to Marc, editor and publisher of the Gloom, Boom, and Doom Report. You're laughing. How come?
Yes. Well, sometimes you're right and sometimes you're wrong. We all have to stay humble.
But you have been right several times. We were actually talking about this in the newsroom. Eric Schatzker and I were saying, you called the market crash. Yeah. You called this.
Yes. If you talk a lot, half the time you're right, half the time you're wrong.
No, you're not being fair. How do you make these calls?
Well, I think sometimes a call is easy. It was easy to call, say, the Japanese bubble in '89. It was a bubble. Or it was easy to say that Nasdaq stocks were overvalued in year 2000. Or it was easy to say that the market was oversold in March of this year. Because if you measure the market from the trend line, it was so far away, and the sentiment was so negative that a snapback rally had to come. Now, have we seen the lows for this cycle? I suppose yes, that we've seen a major low in March 2009. The question is, will this low be also in real terms? What could happen is the Dow doubles, but then inflation adjusted or against gold, the market doesn't move up. In theory, the Dow goes from 10,000 to 20,000 and gold goes from 1,000 to 3,000.
Right.
So in gold terms, you go down.
Well, is that what you're expecting? Gold 3,000?
Well, we have to ask Mr. Bernanke how much money he will print. But I think that he will print like never before in history. He's the John Law of the 21st century. And
I know you've been very critical of him and what he has done.
Yes, very critical. Yes, he's a criminal.
He's a criminal. I know how you feel. But all right, I'm going to play devil's advocate for you.
Yes, please.
All right. Some say he had no choice to do certainly what he had to do over the last year or so.
Yes, and my answer to this, if we play devil's advocate, is if you were a Fed chairman, would you just pay attention to core inflation in structuring your monetary policy? And would you disregard entirely credit growth and in all the speeches and papers that you publish never even mention excessive credit, excessive leverage and credit growth in excess of economic growth?
It's obvious to you.
Yes, that is obvious to me.
Well, Marc, how come they missed it then in your view? Because, as you said, watch these extreme moves, and that was an extreme move.
The reason they didn't pay any attention to is that with the exception of very few economists, John Taylor is one of them at Stanford in California. If you read recently the article published by Krugman, 6,000 words, and he blames other economists, how did they get it so wrong? The article should have been entitled, How Did I Get It So Wrong? But basically, in the entire article, he never mentions once excessive credit growth or excessive leverage, not once. And American economists at the Fed, at the Treasury, and including Mr. Greenspan, and at universities, they totally disregarded this excessive credit growth, with the exception of people like Robert Shiller and John Taylor.
Okay, but this is the situation we're in at this point.
Yes.
So what do we do from now? First of all, I'm assuming you're thinking Ben Bernanke shouldn't be in place to unravel this.
Yes, that anyway. But
and Tim Geithner, for that matter.
No, they shouldn't be there. But I'd like to make the following observation. To us economists, by the way, you will interview, I think, David Tice later on.
Well, we actually talked to him this morning.
Yes, okay. He will also give you a similar story. If you have a problem that arose as a result of excessive credit growth and excessive debt levels in the system, you can't solve that problem by piling up even more debts. In other words, monetizing your debt and creating large fiscal deficits. You can postpone the problem. And I think the problem I have with this entire recovery, and I think stocks can easily go higher. If you print money, they can go to anywhere, like in Zimbabwe or in German Weimar hyperinflation. But you just postpone the problem until the ultimate crisis happens, and that will happen one day.
All right, so here's a theme from you. Basically, watch these extreme moves. So what we're seeing right now is extreme debt, by the U.S. government, extreme stimulus moves around the globe. So tell me, in your view, what is the next crisis and how soon do we get there, considering the extreme levels that we've seen in a short period of time?
But that is the difficulty. I mean, we have debt to GDP at 375% plus the contingent.
But we often see that in a recession, and this was a recession unlike any other.
We can go to 450%. We can go to 500% if you monetize. But you cannot have forever corporate profits growing at a faster rate than nominal GDP, nor can you have forever credit growing at a faster pace than nominal GDP. The hour of truth happens one day. Now, I don't know whether it's going to be tomorrow or in 3 years, 5 years, 10 years, but the next crisis will bring down the entire capitalistic system.
You're so sure about that?
Yes, including Bloomberg and myself and everybody.
Don't say that. All right, well, wait. I'm going to take it back a little bit because we've got the Fed meeting, two-day meeting. We're going to get something from them tomorrow. I think everybody's wondering, when do they start to unravel their unprecedented moves? I mean, to me, it sounds like you're saying we should start doing this already.
Well, they shouldn't have done it in the first place.
Right, but now that
in my
we're here,
opinion, what will happen is that they can't unravel the fiscal deficit because if you reduce the fiscal deficit, it has a contractory impact on the economy.
Right. That's the tough position there.
Yes, and also I think that with the current account deficit of the U.S. shrinking, in my opinion, the monetization will have to go on in the United States because there will be less foreigners buying U.S. Treasury securities.
But we haven't seen that.
Well, the purchases of foreigners, the purchases of foreigners have slowed down. Definitely, that has slowed down.
All right, but we worry about the Treasury auctions.
If they had increased substantially, the dollar would be going up and not down.
So it's happening already, you're saying?
And I mean, look, the dollar weakness is a symptom of inflation in the system. It's not that weak currencies produce inflation. It's when there is inflation in the system as defined by money supply growth and credit growth, then your currency weakens. But of course the other countries do the same. I mean, the US is not alone. Central bankers are all in the same boat. They have only one recipe, is to print money. The only central bank that is, I mean, halfway decent, or the best probably, is the Reserve Bank of India.
Only that?
Yeah, I think it's the best central bank in the world, personally.
All right, we got to take a break. We'll talk more about that when we come back. We are talking with Marc Faber. We'll take a break 20 minutes after. Back with him in 2 minutes' time. Stick around, everybody.